Annual inflation in the US eases back, but by not as much as expected. Welcome to Market Insight. I'm Ramzan Karmali. Well, CPI inflation came in at 2.4%, closing in on the Fed's 2% target. However, core inflation remains stickier at 3.3%. Before today's release, the S&P 500 and the Dow Jones hit record closing highs. So will this run likely continue as the Q3 earnings season continues, with some US major banks under the spotlight on Friday? Well, to help answer that and more, I'm joined by Mario Unali, Head of Investment Advisory at Kairos Partners. Mario, many thanks for your time. So what's your reaction to that inflation print? Does it mean the markets are right to price in an over 80% chance of a 25 basis point cut from the Fed next month?
I think that's right. I think at this point, this is the most likely outcome for the Fed at the next meeting. There was always going to be the risk of a rounding up of the number. Today's CPI was, very much in line with expectations, except for, a slightly higher number. I think the narrative, though, is unchanged. Inflation is actually coming down, as you said at the beginning. Inflation is something that is by nature bumpy, and it doesn't really move in one direction over a long period of time. So this is all to be expected, but it doesn't really change, the narrative in the market either. So I am still confident that, prospects for equity market, especially in the US, are quite positive.
Well, let's talk about those markets now. As I mentioned, we saw some record highs from some of the big indices yesterday. Is that likely to continue today and going forward?
Well, we're entering an interesting few weeks, right? With U.S. elections. So I think one of the risks is that some investors, on the back of positive numbers, will actually try to unload some exposure and sell part of their, investments. On the other hand, there is a risk that is quite underrated, in my opinion, and is the upside risk. So the fact that some people will not participate enough to this bull market at the end of the year, so they will have to chase the market. So we will have to remember that new highs are bullish, and that when the market hits, new highs, this is sometimes a buying signal. It doesn't necessarily have to be read as a caution signal. So we remain quite positive and optimistic.
Now, the US dollar hit a 10-week peak against the yen today before easing back. What have you made of the dollar's recent strength? Is it all down to this perception that the Fed will be more patient when it comes to easing?
That's one part of the equation. The other one is the strength and the continued strength of the U.S. economy compared to any other economy in the world. When you look at the euro, for example, it had like a decent run up in the last few weeks, but then the fundamentals are there, and I don't personally see the euro being too strong against the dollar. So at this point, you find yourself with a great U.S. equity market, and also with a strong dollar, which is inherently defensive. So this is a great way to gain exposure to the market while trying to hedge your exposure somewhat on the currency side.
Now, I said that the Q3 earnings season has kicked off this week. Banks come into focus tomorrow. Got JP Morgan and Wells Fargo reporting. But in general, what are you expecting from this earnings season?
The market is expecting a very rosy picture, and I think I underwrite that to some extent. Obviously, we will have positives and negatives because dispersion is quite high compared to historical standards. But overall, I think the positive expectations are justified by the resilience of the economy. Even China, with the recent stimulus, is showing that they really care about hitting that 5% target. And when you look at the nowcasts for US GDP, they're all around or even above 3%. So that will have to be reflected in earnings.
Now, you mentioned the US elections earlier. What bearing do you think the results will have on the stock markets?
Well, I see three possible outcomes, really. The two extremes and something in the middle, which will be positive for the market. When you look at the two extremes, probably the market will like the Trump extreme better, where the Harris administration will have to prove that they are market friendly. So we will certainly see more volatility compared to recent recent session in the market. But I don't think that the market will focus too much on politics, given how resilient the economy is. So we will all be about earnings. It will all be about stock prices, and we will keep our views unchanged for the foreseeable future.
Mario Unali from Kairos Partners, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.